Joining us to talk about what he's seeing in the markets right now is Tom Lee. He is Fundstrat Global Advisors managing partner and a CNBC contributor. Tom, it's weird. We are sitting very near all-time highs, and yet it does feel like there is some nervousness in the market at this point. A lot of this is coming from hotter than expected inflation numbers, stronger than expected jobs reports, and manufacturing numbers, the ISM, that was better than anticipated, too. That's got people wondering if the Fed is actually going to be able to cut rates this week. Are you unnerved by any of this?
I think this coming Wednesday, Becky, will really answer a lot of questions because I think you've summed it up well. Investors have been grappling with this idea that can the Fed be in a position to, reduce real rates if we've got good economic growth? Because what does that mean for inflation? And this coming Wednesday is March CPI. I think it's going to be the first clean CPI report of this year. It won't have any residual seasonality. We're expecting that to be a pretty good report, lower than expected inflation. And I think it's going to help investors get to this place where we can have pretty good growth in the economy. There's some slack in the labor markets, but inflation's falling fast enough for the Fed to actually cut rates this year. And of course, that'd be great for stocks.
I know you'd been telling people kind of buy on the dip, not that there's been much of a dip if you're just talking about a pullback of a few percent. Does it matter if the Fed cuts rates or not? If the economy is really strong anyway, will earnings be able to justify the valuations at this point?
I think the Fed being supportive of the economy, so managing the business cycle, is the most important thing. In the last 2 years, the Fed was fighting inflation and therefore hawkish. That was tough for equities. But if we're in a mode where the Fed doesn't know how many cuts it needs to make, but it actually wants to support the business cycle, that's good for stocks. So I don't think you need to have 3 rate cuts. You could even have a good scenario where the Fed only cuts once. But if the Fed's in a position where they feel they need to actually raise interest rates, that'd be bad for stocks.
Hey, Tom, hold on just a moment. We've got some breaking news. We'd actually like to get your reaction, so if you don't mind listening in.
We just have some news literally crossing this moment, which is that Jamie Dimon's JP Morgan is publishing his annual letter to shareholders. And we want to bring you some of the news that's in this letter, a highly watched letter annually. Dimon writes the following. He says that despite the, quote, unsettling landscape, war in the Middle East and Ukraine, growing geopolitical tensions in China and polarized electorate here in the U.S., that the U.S. economy, he thinks, continues to be resilient with consumers still spending. He says the market seems to be pricing in a 70 to 80% chance of a soft landing, but Dimon thinks the odds are, quote, a lot lower. He cites persistent inflationary pressures, including what he says are, quote, ongoing fiscal spending, remilitarization of the world, restructuring of global trade and capital needs of the new green economy. Another major theme in the letter is artificial intelligence. Dimon writing that the consequences will be extraordinary. He says J.P. Morgan Chase has grown its AI organization, quote, materially with more than 2,000 machine learning experts or data scientists now on the payroll. Dimon also issuing a warning, quote, we may be entering one of the most treacherous geopolitical eras since World War II. He said he's also concerned about the large deficit supported by quantitative easing. I will say on the World War II piece, he says when terrible events happen, we tend to overstate or overestimate the effects that they will have on the global economy. Recent events, however, may very well be creating risks that could eclipse anything since World War II. We should not take them lightly.
I mean, that's the risk manager side of him. Right. But it's interesting. Jamie Dimon, I think, is somebody who's always been fairly optimistic about the United States and the economy. His concern about some of these geopolitical events is one that is echoed by other people who are generally pretty optimistic about things. Right. If you talk to a Warren Buffett or someone, too.
The letter generally, I should say, is what I would describe as cautiously optimistic. Yeah, I think tonally we've just hit on what I would describe as the news pieces in the letter.
Right.
But I think tonally it's an upbeat letter. He's talking about AI. spends a bit of time. This is 20 years now, 20-year anniversary since the bank won JP Morgan Chase deal, which actually put him in charge of the company. Talks really about the growth of the bank. It's now the largest bank by market cap in the country. Goes through a whole number of other pieces to it, management lessons and other things. It is a worthy read, by the way.
There's only a few CEOs who actually really write their own letters without worrying about lawyers and lots of other people going through and reading it and telling them what they can say, what they can't, actually writing it for them in a lot of cases. I mean, Jamie Dimon, obviously a huge one, Warren Buffett, Jeff Bezos always wrote a very straightforward letter from that you could tell was written by him with their voices. I think Larry Fink's letter this year was up there with that, where he wrote about his parents at the very top of the entire letter. That's why these letters are so interesting. And I think the tone and his tone on the markets is one that he's been kind of consistent about over the last year or so, and that is the concern about a soft landing not necessarily being as certain as the market expectations seem to be, and concern about higher inflation. Maybe we can ask Tom about that right now.
Well, Tom's been the bull, though. Yeah. Tom's been on the other side of this, Tom. What do you think?
I think Jamie's doing his shareholders justice because they want to hear from him about all the concerns out there. I think he does a great job of detailing all the things that could go wrong. But at the end of the day, when it comes to markets, I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion of cash on the sidelines. And inflation, we don't really know how quickly it's going to fall, but our bet at Fundstrat is that it's going to fall pretty quickly, means some of the concerns he listed about a hard landing are because of sticky inflation. And if it's softer, I think we're going to have quite a good economy.
Is this a two-pronged outlook on the economy and the markets, though, Tom? Is inflation the one big issue? And if Wednesday proves that it's a hotter than anticipated or hotter than expected CPI number, would you change your ideas about what that means for both of those things for the long term or for the year?
That's right. I think if inflation, because March is going to be the first clean CPI report. We know out of Europe, they've come in pretty soft. They've come in better than expected. If it comes in higher than expected, then I think it raises the question that the inflation is quite stubborn, and getting to that from 3 to 2 is going to be difficult. On the other hand, if it is a soft report and we think it's the probabilities favor below a 0.3, that's consensus core of 0.3, I think it's going to change a lot of people's minds that inflation may not be that stubborn.
Yeah. You have been telling people to buy, or you yourself have been buying on any dips. And by dips, we're not talking 5 or 10% drops. You're talking 2% drops, and you'd be buying into the market?
That's right. I think that there's many reasons that we still think there's gas in the tank in this rally. Part of it is that we do think the inflation trajectory is on a glide path lower than consensus expects. The second is I think there's too much caution out there. When you look at prime brokerage borrowings, or basically leverage in the market, it's still below where it was in October 2021. There's still $6 trillion of cash on the sidelines. In our conversations with clients, they're still quite cautious. So as long as investors are top calling and are really looking at the world half empty, I think stocks can still rise on this wall of worry.
Mohamed El-Erian is here, Chief Economic Advisor at Alliance and President of Queen's College at Cambridge University. Play-by-play commentator, that's kind of harsh. You're not usually like that.
Well, it's because of the amount of volatility they've put into the marketplace. The Fed should be the strategic anchor to this market and leave the play-to-play commentary to others. What we found is with 19 federal officials speaking, they've become a play-by-play commentator. And we saw last week what that does to market. It imposes an unnecessary amount of volatility onto it.
It's because we feel like we're at an inflection point, right? This is, it's one thing for everybody to be talking when we kind of know the direction of things, but I think everybody's looking for any cue anywhere to try and figure out what the Fed will do next, because it's just unclear.
Yeah, and there's a couple of things going on. One, I think the whole notion of transparency is being implemented in the wrong way. I'm all for transparency, but it has to be in a way that fulfills the objectives of
transparency, but nobody's allowed to talk?
No, just talk, but talk with a longer-term view. Don't talk on every single change. And the other thing is this Fed, unfortunately, has become excessively data-dependent. And when you become excessively data-dependent, you start being swung around by the data. You know, there's an old image that...
But shouldn't you be excessively dependent on the data? Shouldn't that be the whole game?
No, high-frequency data tends to be incredibly noisy. So if you're excessively data-dependent, the image you have is of a roller coaster. The markets, the data, the high-frequency data on a roller coaster. And the Fed has two choices, either to get onto the roller coaster or stay on the side and try to provide the anchor.
So your argument was that they should do nothing right now and kind of wait it out and see where the data heads? Or
No. If you take a strategic view of the economy, they should definitely cut twice. If you are overly data dependent, you're going to be taken to a place where you may end up not cutting. And that's going to be the difference. And if you don't cut, that may unnecessarily undermine U.S. economic exceptionalism.
Let me read you, Mohamed. This is Jamie Dimon's letter, came out this morning. And he says, many economic indicators today continue to be good and possibly improving, including inflation. When looking ahead to tomorrow, conditions that will affect the future should be considered. For example, there seems to be a large number of persistent inflationary pressures which may likely continue. All of the following factors appear to be inflationary: ongoing fiscal spending, remilitarization of the world, restructuring of global trade, capital needs in the new green economy, and possibly higher energy costs in the future, even though there currently is the oversupply of gas and plentiful spare capacity of oil due to the lack of needing investment in the energy infrastructure. What do you make of that?
I think Jamie Dimon is absolutely right. I think that the last mile, so-called, in the inflation battle is going to prove much more difficult than most market participants expect because of the reasons he cited. We live now in a world where the supply side is a problem, not the demand side. The big debate is, does that mean the Fed should pursue a 2% inflation target regardless of the change in the global macro paradigm? Or, in my view, it should be tolerating slightly above 2% in order not to sacrifice the economy.
So if you do no cuts, right? What happens to the economy? And by the way, there's the economy, but then there's the impact that all of this government debt that we have is going to ultimately have on the economy.
Correct. There's a huge fiscal issue that we don't talk about enough. There's a huge structural reform issue that we don't talk about enough. We are too focused on the Fed and on inflation.
But no, what I'm saying is, should the Fed be even thinking about the fiscal issue, which is to say that the cost of our debt is going to become a problem very soon if it isn't already?
But if they start thinking about that, then they're basically enabling the fiscal authorities to continue doing that if they're cutting rates to make sure that we don't get out of hand with those things.
Correct. And they shouldn't be thinking about it. Whether they do or not, I don't know, but they shouldn't be thinking about it. What they should be thinking about is their dual mandate and what is the right inflation target. Or if you want to be sort of more diplomatic, when do you want to get to 2%? Do we need to get to 2% quickly? Or can we get there over the medium term? And if you've noticed, a very important descriptor has come into. Whenever they talk about 2%, they say the longer-term objective of.
Larry Summers has been pretty critical, too. He is saying they shouldn't do anything right now because we can't even decide on what a neutral rate is. I just heard him saying that if you don't know what the neutral rate is, that's like driving a car and not knowing what your speedometer says. Like you just don't know how fast this economy should be running at this point, and that's a reason for doing nothing.
Yeah, Larry reacted quite violently to the comments of Chair Powell last week, when Chair Powell said, we don't know where our start is. And Larry's point, which is correct, is, well, you better have some view as to where our start is. Again, that is an illustration of a Fed that's too data dependent, that is not looking at the strategic element. Of course, you have to have a view of where our start is. That's so critical to your path.
We want to bring in Ed Yardeni. He's the president of Yardeni Research. And Ed, I was trying to get a feel. You read so much and you have such a good sense of how markets are trending, what the psychology of markets are. You said a couple of things recently that gave me pause. Just this idea that maybe you think things have run to an extent, the farthest extent they can with the stock market for now, and that you do have some concerns about the bond market. Why don't you lay out what you're thinking, how you're feeling?
Well, I think in the near term here, we really have to focus on what's happening in the commodity markets, particularly in the oil market. The price of crude oil has jumped above $90 a barrel. It did that last week. And now this morning it's back below $90 a barrel, but it looks as though it could very well head up to $100 a barrel if the situation in the Middle East continues to deteriorate. So I've been focusing on the geopolitical concerns, which have not been getting better. They've been getting worse. There's obviously increasing risk of a direct confrontation between Israel and Iran. And if that were to happen, then the price of oil could very rapidly get up to $100 a barrel. The short-term inflationary consequences, I think, would force the Fed to basically concede that there's not going to be any rate cutting this year, and that the concerns about a wage price spiral might be back. So that's kind of where my concerns are. With regards to the market, as you said, Becky, I think we're at a 21 forward PE. I think from here on, the market goes up on earnings. And I do think that the outlook for earnings is actually pretty good. But I think this straight up move that's been based on valuation might be behind us for a little while.
It's interesting, though, even if the Fed doesn't cut rates, as long as we don't see a huge spike in inflation,
right,
maybe companies can make up for some of these things. So you're just weighing the risks and balances, not saying that things are necessarily overvalued or that there's anything wrong here. I mean, not that there's nothing wrong, but...
Yeah. Becky, I've been kind of looking at previous decades for analogies, and I'm still thinking this will turn out to be the roaring 2020s, kind of similar to the 1920s, where we had tremendous productivity growth and tremendous prosperity. Obviously, it didn't end well, but for a good time there, it was a good time. And I mean, under that analogy,
we got another 5 years left to go, Ed.
Yeah, absolutely. So there's room to grow. On a short-term basis, I'm worried about the 1970s, where we had two spikes in the price of oil, and that was a wage price spiral that was persistent and forced the Fed to raise rates. I think there's a small chance of that happening, but it is a geopolitically related risk. And then there's the 1990s, which was irrational exuberance, which looked to be the case over the past several weeks. If you ask me to put probabilities on it, I'd say 60% likelihood that it's going to be the roaring 2020s, and then 20% each for the 1970s and the 1990s. Now, you mentioned Jamie Dimon. Jamie Dimon seems to be talking about the 1930s. So there's a lot of decades that we can look back to.
Bottom line, though, you'd tell people don't necessarily add to your holdings here, but you wouldn't sell out?
Yeah, that's correct. And I'd overweight energy. I've been recommending that for a while, and it's been a clunker. But now it's working out quite well. And I think there's going to be some profit taking here.
Dan, let's talk about CERAWeek and some of the things that came out, because I had never seen one of the issues that you guys kind of got to the bottom of, this idea that electricity demand in the United States is rising far more rapidly than we can possibly keep up with it.
Until 2 years ago, it was utilities thought they were dealing with flat demand, declining demand, and suddenly it's turned around. And one example is that if you go back a year and a half ago, in the earnings calls of electric utilities, we noticed there were like 3 mentions of data centers. Most recently, there are 120 mentions. Oh. And it is the data centers on top of the electrification, on top of EVs, but the data centers and AI, this is the driver. And everywhere, even in Northeast now, they said that the forecast from 2 years ago is now been doubled for what the growth is. And that's a challenge of how do you build and what do you build?
I mean, it takes years and years and years and years to build out additional production or additional output for electricity. Are we prepared for this?
No, I don't think so. And there's permitting issues, whether you're doing transmission lines, whether you're doing new plants. One thing this has given a boost to are the small nuclear reactors. At CERAWeek this year, it was like they're going to happen. That was the difference there. They could be next to a data center. Data centers are what use the vast amount of electricity.
How quickly could those be spun up, though?
What?
I mean, both from a regulatory perspective and a physical, like how quickly can you build them?
Well, at this point, the nearest ones that I know about are like 2030 that they think they can do it. So there is absolutely that problem. And
but that's the 2030 to get regulatory approval locally
to get the first,
or federally? That's the other thing.
Dow says they'll have one in operation in 2030. And one of the other things I noticed at CERAWeek this year is the optimism around nuclear that we hadn't seen before.
Is there still a not in my backyard issue with it, where it sounds like a great idea, build it somewhere else?
Well, there will be that question, and it goes back to what Andrew said. There clearly will be the permitting issues, because the other theme that ran through the conference is in terms of getting anything done in the United States. Permitting is a really big problem.
Dan, last week we talked a little bit about EVs and the battle between EVs and hybrids. Hybrids have been pretty fantastic, because I think the difference is you have all the benefits of better fuel mileage, all of these things that are great for the economy, but the customer doesn't really.
Well, I heard you last week talk about your personal experience of hybrids.
I love it. The hybrid's great. I don't have to do anything differently.
Yeah, it does it. But it's very different. If you look at China, 35% of new cars are EVs. Europe, 24%. Although in Germany, take away the subsidies, sales go down. U.S., it's about 10%. And you had those 4,000 dealers who wrote to the White House saying, put the brakes on EVs.
I have a hybrid question, though, and actually it's interesting. Henry Blodgett had been on Twitter a week or two ago asking a similar question, which was, why are there not more hybrids?
Yeah,
and why not sort of reverse the scheme so that there's like a little bit of hybrid at the end, make basically an electric car with a tiny amount of hybrid rather than a gas-powered engine with like a little bit of battery. And it seems that most of the folks that are in this industry feel like it's a simplicity thing, which is to say either you're all electric, and if you want to add some distance, add an extra piece of battery, or be in the combustion engine business. But to do both is more expensive, more complicated, et cetera. Is that true?
Well, it is true. A hybrid is a more complicated car because there's two engine systems. And a couple of years ago, the embrace of EVs by the major automobile companies, they said they're simpler to build, but they've run into the consumer resistance over them. And that the system, we don't really have the charging system. And we don't have people, we're a consumer society. People were not ready to go that way.
It's the Amazon principle, to give the customer what they want.
Right. And the one company that stood out was Toyota, which said, kept saying hybrids, and everybody else was over there.
Toyota,
and now they're done well out of it.
After we saw a hotter than expected jobs report, what are you expecting when it comes to the markets? And even today, we saw futures lower, and now they've moved higher.
Yeah, well, look, I think the big read is going to be the inflation data coming out on Wednesday. When we looked at the inflation readings in the payroll numbers last week, the labor participation rate did tick up. I frankly think that's the only thing keeping a June rate cut on the table. Otherwise, I do think it's going to be pushed back. And I agree with every time the number of rate cuts goes down, I think that can put some pressure on the markets. So we'll see what happens on Wednesday. And it could, if it's a hotter than expected read, or frankly, even in line, I think you could see some pressure on equity markets.
So, Robert, similar question for you. As I mentioned, futures were lower this morning. They're still in the red, but just certainly off of their lows. At the same time, we've seen bond yields. When the 2-year and the 10-year hit their highest level since November. How do you see that impacting today's trading?
We're going to see global rate cuts this week kick off, and the Federal Reserve is going to have to keep higher for longer. And they're actually searching for something that gives them any sign that they can actually join the party. But I don't know that it's going to happen sooner than later. I think June could be very questionable, so it could be kicked to September moving forward.
So, Robert, you have a lot of questions about it. It sounds like the CPI report that's coming up on Wednesday. In the meantime, how do you see investors reacting to some of this uncertainty about that June cut?
Yeah, I think it's a wait-and-see environment, especially for investors. Keep some powder dry. Take advantage of the opportunities. I mean, this has been a stock picker's market year to date. It's been continuing since 2023. That's how we're seeing it for our clients, and we're actually taking advantage of a lot of opportunities, even amidst all of this uncertainty, Frank.
All right, speaking of uncertainty, there were a lot of questions about the U.S.-Chinese relationship as recently as July when Janet Yellen visited. Now it seems like we're on a more of a path of better cooperation, but still some tough talk on both sides, Patrick. How do you see that relationship impacting the U.S. stock market, but also big U.S. companies that do operations in China, McDonald's, Starbucks, Nike, just some of the names that come to mind?
Sure. Well, look, the better trade relations are with China. I think the better it is for U.S. multinational companies. The interesting thing I see from China, though, if you actually look at the average investor in China, right? They've been burnt in their own stock market. They've been burnt in housing. When you look at things that they're investing in, right? And this plays in exactly to where rates are, et cetera. If you look at the move in commodities, particularly in the metals, that's showing that I believe that we're going to have inflation higher for longer. And likely that means we have rates higher for longer. And if you look at where the average Chinese investor is investing today, it's actually in gold. And so it may be a little surprising for people, but gold has been extremely strong. And I think that's created some upward pressure on some of the commodities markets. And it's an indicator of expected inflation.
Yeah, one of the catalysts for gold has been buying by the Chinese central bank. But I want to switch gears a bit to another commodity, gas. Patrick, your pick for us today is kind of focused on gas. Give us the name and very quick, the elevator pitch, why you think that's a good stock to invest in today.
Yeah, actually, I don't think it's necessarily a play on commodities. It's Murphy USA, gas station and convenience stores, very simple business. I love these sort of, I call them, value type pick. It's trading at 9 times EBITDA. We've owned it for 10 years since it spun off of Murphy Oil. It's a well-run company, and they have very, very steady margins. And I like these sort of boring businesses, if you will, but they've had a tremendous track record. They buy back stock as well. Really a good company to hold in a portfolio, and it's been a stalwart in our portfolio for 10 years, as I said.
All right, Robert, I want to come over to you. You're actually looking for opportunity in the liquid natural gas sector. ExxonMobil is a stock you're looking at for today.
At the end of the day, we have oil at $87 a barrel. We're going to see $100 by the end of the summer. Strong balance sheet, structural cost savings, healthy valuations right now. At the end of the day, it's very attractive. You're going to get paid while you wait, 3% dividend. And at the end of the day, you got geopolitical tensions all moving with wind in your sails. So that's why we like ExxonMobil at this moment.